getting them to be part of our democracy in an ever-changing landscape of different voting rights. So this is an organization that makes a big difference. Sansia walked through all the horrors in the world today. If there was ever a time to support RFK human rights, it's right now. So thank you, Carrie. You've built an incredible organization. As Marvin said, both myself and Jose Feliciano of Clear Lake agreed to be co-chairman of RFK about 18 months ago. And we knew we were stepping into the middle of a little bit of a firestorm. We were dealing with COVID, a contested presidential election, January 6th, the aftermath of George Floyd. So there's a lot of topics for us to talk about and to prioritize for the organization. But once we got in our seats, more challenges kept hitting us, all right? I mean, there have been no shortage of them. An incredibly heartbreaking war between Russia and the Ukraine. And as Sansia mentioned, rising interest rates and inflation. And inflation to 95% of Americans mean they have to think every time they go to the gas pump. Do I have enough money to make it to drop my kids off at school and get to work? You know, the rising prices of food in the grocery store, do I have enough money to put food on the table of our families? This is an incredible time. And that's the power of what we have to do today. If you map economic turmoil throughout the history of time, that's highly correlated with increasing violations of human rights, right? So we really have to be focused on this as we try to navigate a pretty tough time in our markets. So today in this room, we have several $1 trillion of capital that's represented by us. And we're going to spend a lot of the time during the course of today talking about how to invest that capital in a rational way, given the markets seem to be a little bit irrational. But the power of what we need to accomplish while we're trying to thread that needle is also address human rights issues. And it's that combination and the ideas that come out of that which is actually going to make a difference. If we're going to be successful today, it's also important that we all participate. I know we live in this culture, cancel culture. People don't really want to speak their mind. They're afraid to put their ideas on the table. We can't do that today, right? We're in a very challenging times. We need as many great ideas on the table so that maybe collectively we can find a path forward. So please speak your mind. Please engage in these conversations because it's much, much needed. In RFK Human Rights Speak, Carrie talks about a ripple, right? And these ideas are ripples. And if we have enough ripples, they spread through our community and they drive hope and they drive change. In private equity speak, we call that leverage, right? We got a lot of bright minds in the room today. We should leverage them all to figure out the best path forward for all of us. So please engage. Please take advantage of what we all have to share today because, again, we have a pretty complicated world that we need to navigate. So to kick off today, I have the pleasure of introducing our first panel. We have Bob Pisani, who I'm sure everybody in this room knows. He's a leading reporter on CNBC, which in times like the talk. And it's that type of leadership that is also going to make a big change in the environment that we're in today. So without anything further, I'd like to turn it
over. Thank you very much, everybody. I am very happy to have this discussion with SEC Chair Gary Gensler. Now, before joining the SEC, Gary was professor of the practice of global economics and management at the MIT Sloan Management MIT Sloan School of Management and the senior advisor to the MIT Media Lab Digital Currency Initiative. From 2017 to 2019, he served as chair of the Maryland Financial Consumer Protection Commission. He was also formerly chair of the U.S. Commodity Futures Trading Commission. So the format here is we're going to have 20 minutes of conversation with Chair Gensler, followed by 10 minutes of questions. Chairman Gensler, thanks for joining the conference. I can't help but note that Robert F. Kennedy Human Rights is run by Kerry Kennedy, who's the granddaughter of Joe Kennedy, the very first SEC commissioner way back in 1934. So it's very special to have you here. This is an organization that's very concerned with justice and human rights, but it's also concerned with broader issues like climate change and shareholder activism. These seem to be issues that resonate with you as well. Now, you've got proposals out on more climate change disclosure, for example. You have also said investors want more information on climate change. You're also calling for more disclosure on board diversity and how companies manage human capital. I'm wondering, how do these social and environmental issues inform your stewardship of the SEC?
Well, Bob, thank you. I thank Kerry for inviting me. And I do think in this job about her granddad. And I know that she probably didn't know him all that well, but she knew him when she was a kid. And it's a great honor. It's big shoes to fill. And I think as he thought about it, it's how do we make sure that the markets, with all of the incentives in marketplaces, with sophisticated investors, non-sophisticated big investors to retail investors, all collide and do what capital markets do, help a better life for savers, better opportunity for companies raising money, a better economy. And so it's an honor to be in his seat. I would say that in terms of what you just asked, we're really market regulators. So I know it might be a little surprising for this audience, but we are disclosure-based. We make sure that people don't lie to the public. We make sure to protect the markets against manipulation and the like. And so we are living in a time right now that investors want the information you just said. They want climate risk information. They actually want more information about cyber risk as well, and about human capital. And so we're trying to help standardize those disclosures.
You mentioned disclosure several times. If there was one theme that I see following you and covering you for the last year and a half, it would be that theme, transparency and disclosure. For example, you have a proposed rule on private fund managers that would require them to provide investors with quarterly statements detailing information on fund fees, expenses, performance, more disclosure. You have proposed enhanced disclosure around insider trading, corporate buybacks, and also around diversity of board members. This is a wide swath of issues, but they all have that theme of transparency and disclosure. But some in corporate America are saying you're drowning them in disclosure requirements that dramatically increase the cost of doing business. Now, given that cost is a factor in the rulemaking process, how do you balance that out? Why is transparency and disclosure so important right now, and how will that help protect investors?
It's really at the core of our capital markets and a basic bargain that came along when Roosevelt set us up and Chair Kennedy ran the agency. And it was about investors get to decide, but companies have to give full and fair disclosure and not lie. And over the decades, we've updated it. In the 1970s, we added environmental disclosures. In the 1960s, risk management. And this was when I was coming of age, and my dad never went to college. Mom never went to college. He would try to take a little bit of money, maybe buy 50 shares of this or 25 shares of that. And he'd think, about each of those investments and look at some public disclosure. Well, in the 2020s, public disclosure currently includes climate risk disclosure. Hundreds of companies are making the disclosure. And so we're trying to help the markets be efficient and bring some consistency to that disclosure.
So besides transparency and disclosure, there's also criticism that you're stepping outside your lane on a number of issues. So the SEC's agency rule list for the fall, and the rule list, those of you who don't know, is a sort of wish list of what the SEC would like to accomplish in the next year, had almost 50 proposals on it. This is one of the most ambitious agendas in many decades, and it included enhanced disclosure on climate change. So the comment period for climate change disclosure is ending soon, and a lot of people have written to say that this is an issue beyond the purview of the SEC, that it is essentially an issue for the EPA, not the SEC. How do you respond to those kinds of criticism that in this particular case, and maybe in others, you're sort of stepping outside your lane?
Well, again, please weigh in if you're listening in the public or if you're there in Hyannisport. Please weigh in because the comment period has several more days to it at the end of this week. We benefit in capital markets by investors getting the choice they want to make and what they think about the future of those investments. And they're making decisions today around the greenhouse gas emissions of those companies, about the risks, and about the future potential risk of those companies, what's called transition risk. And so I think we are actually swimming right inside our lane, Bob, with all respect. We're staying within the good economics. We're staying within the chalk lines of the law. And but again, weigh in, let us know what works. We haven't adopted something. I'm not prejudging where we'll end up, but I think this is consistent also with what's happening around the globe. It's happening in Europe, it's happening in Asia, it's happening in Australia, et cetera. And I would say one other thing that motivates me is our geopolitical standing in the world, ours, the U.S. And part of that are the great innovations of 88 years of this commission and the basic bargains, again, that Chair Kennedy and Franklin Delano Roosevelt came to. I think it's helped our standing in the world that we really do have, in essence, the gold standard of capital markets, but we cannot take that for granted. Even the gold medalist practices and gets better. And so we have a lot in our capital markets that we can do better, and technology is rapidly changing. And I think given that rapid changing, we're looking at updating our stock market, what's called the equity markets. We're looking at something that many people might find a little bit more boring, but our U.S. Treasury markets and how we update that and drive greater efficiency in the middle. Because we've got investors, we've got people raising money on the other side, and that which is in the middle, greater efficiency. And yes, that even means some of the people in the audience there in Massachusetts, the private fund space, we're trying to, through transparency and competition, lower some of the fees and the rents in the middle of the market so investors do better and companies do better.
Yeah, I've heard you use this theme many times. That is that you've got a lot of proposals out there because the world is changing fast and the SEC has to change along with.
And I also think, if I can interrupt, we can't take anything for granted. Other countries want to take our place on the world stage, and we've got to be diligent. So if I get whatever God and the public gives Joe Biden and so forth, if I get 5-6 years in this job, I hope to leave our capital markets, as they say, more efficient, less costly, and also thinking about working families, regular families, young folks just starting out, using their brokerage app, trying to have a better future, retirees at the other end of their savings lives and everything, to get a better deal out of the capital markets.
Let me ask you some specific questions about issues you've addressed recently. The crypto community has been, I think it's fair to say, bitterly disappointed that you have proven very resistant to approving a pure play Bitcoin ETF, something the crypto community is very interested in, though you have approved the Bitcoin futures ETFs, a series of them. How do you feel about the recent volatility in the crypto market? And does it make approval of that Bitcoin ETF more or less likely in the next year?
Let me just say this for the audience, a little bit about this guy, Gary Gensler. I'm sort of intrigued with the technology, so intrigued that I decided late in 2017, early 2018 to go up to MIT. It was a great to research and teach at the intersection of technology and finance, artificial intelligence, and yes, cryptocurrencies. I think there's some real innovations in this space, not just about money or ledgers, but also about finance itself. But though I am technology neutral in the job right now, I'm not technology naive, and I'm not public policy neutral. It's important that these markets have investor protection, and it's a highly speculative asset class. And like most venture capital, most of these projects are likely to fail. I can't prejudge any one of them. That's for the investing public. But guess what? The investing public benefits from the same disclosures that Chair Kennedy was trying to get out of corporate America 88 years ago. Same thing. And without those disclosures, you have companies out there saying, come hither, give us your hard-earned money, and we'll get you 17% returns or 19.5% returns or 7.1% returns. And Bob, frankly, in this interest rate environment, one has to wonder where those returns are coming from. It's not the SEC's to wonder, it's the SEC's to require appropriate disclosures. And yes, for the platforms, lending and trading platforms that have crypto tokens on there that may well be securities, to talk to those platforms and get them registered under a law to protect the investing public. That's what it's about. And it's a highly speculative asset class. And many of the tokens and the platforms are trying to say, no, 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 this is something different. And yet we have an 88-year-old set of laws and rules that actually protect the public against, protect the public and also protect issuers. Good faith issuers making disclosure have a better market if some of the fraud and scams are out of the market.
One of the issues on crypto that you repeatedly lamented is the lack of a clear regulatory authority, regulatory purview over the crypto community. Senators Gillibrand and Loomis recently introduced a bill that appears to give a significant amount of regulatory authority to the CFTC rather than the SEC. Can you comment on that? Where do you have said you want more clarity on who controls what in the crypto community? Does this bill go any way towards addressing that clarity? And
actually, Bob, I just want to help you out there. The laws are actually fairly clear. If you're raising money from the public and the public's anticipating some small group or of sponsors or entrepreneurs for their future, raise money from the public, and you're anticipating a profit based on those entrepreneurs, that's a security. Thousands of these tokens probably fall into that. I'm not preaching.
I think we have frozen on Chair. Going to have to take the mute off. There you go. All right. Sorry about that, Gary. Lost you for a moment there. You were making a point about the fact that the securities laws already are fairly clear on what is a security.
Look, it's straightforward. Congress painted with a very broad brush in 1933 and 34. If you're raising money from the public and the public's anticipating a profit based on some group of entrepreneurs, that's a security. And the public needs to be protected. And that's what Congress said. That's not what we're saying. There are some small number of tokens that predecessors talked about that may not meet that test that are commodities. And they may even have a large percentage of the crypto market. But for the bulk of the tokens in the market, the bulk of the numbers of tokens, they have attributes of securities. And that protection is important. We look forward to working with Congress if Congress wants to weigh in on this. But in the meantime, Bob, we're going to use the authorities we have. We're not looking for any additional authorities. We're just use the authorities we have, whether it's on crypto tokens, most importantly, the crypto exchanges and the lending platforms. We've seen again that lending platforms, they are operating a little like banks. They're saying, give us your crypto, we'll give you a big return, 7%, 4.5%. How does somebody offer 4.75% in the market today and not give a lot of disclosure and like a bank maybe have some important safety and soundness behind it, or like a money market fund? You can't get 4.75% in a money market fund today. So what's happening behind that? And I caution the public. I think about it. Sometimes if it seems too good to be true, it just may well be too good to be true in terms of those marketing and those websites that talk about 7 or 17% returns.
Let me move on to another issue you've addressed recently, payment for order flow. This is the practice whereby some brokers route their orders to wholesalers in exchange for payments. You've implied that you not only want more competition among those wholesalers, but you don't seem to approve of the practice in general. Yet most observers believe that while payment for order flow is not free, the average retail investor has never had it so well, and that the cost of trading has been declining for decades for retail investors. Are retail investors really getting a bad deal here?
So two things. In all of commerce and in science, we seek improvements. We don't just try to stand still, and our capital markets don't stand still. So yes, zero commissions in 2022 is better than what I grew up in the 80s and 90s in the capital markets, but it doesn't mean we can't be better. Secondly, payment for order flow, where a small group of wholesalers are paying for the retail public's orders, has inherent conflicts of interest. And that's why multiple jurisdictions, the United Kingdom, Canada, Europe is currently considering banning payment for order flow. I laid out in a speech a week ago a series of things I asked the staff about what should we do about our capital markets to help level the playing field, because right now, well over 90% of retail market orders, you put it on a brokerage app, you send it in, over 90% of those market orders are going to the dark markets. They're not going to the New York Stock Exchange or NASDAQ. They're going to 2 or 3 or 4 what's called wholesalers. And it's not a level playing field in our markets right now.
And yet the people who are the wholesalers have consistently said that there's other competitors out there besides 2 that dominate. There are numerous new competitors in there. I guess the issue here is whether or not the retail investor is truly being disadvantaged or not. The alternative is...
So I really do believe, Bob, I'm going to interrupt, competition and transparency, back to an earlier theme, is really quite a thing. It can be harsh on the people that have to compete. Those wholesalers are not currently directly competing with pension funds or even the folks that are in this conference. And so many institutional investors, many mutual funds and pension funds are not accessing, not competing for those retail orders and interacting. And so the retail public right now may be getting some price improvement, but not as much price improvement as good old-fashioned American competition would bring. But look, I get it. We have a job for 330 million Americans. We have a job to ensure our capital markets are great in the 2030s and 2040s in the geopolitical sense and this competition. Those wholesalers have a different job. Their job is for their shareholders, their senior management, their customers. And so they have a different job, and they'll articulate it. And if we make a proposal, we'll hear from them. We'll have good debate on this, Bob.
If the alternative was instead to dramatically curtail payment for order flow, and some of the brokers went back to, say, charging commissions, would that, I guess the question, would that be a superior outcome at this point? Something like that happening? Competition
would be a better outcome. And right now, there are large brokers that do not pay, and they have zero commission. And it is not zero cost to the public. Right now, the public is going on a brokerage app that might have a convenient, useful user interface. It might even have what's come to be called gamification. It might be a little bit fun. And mind you, those brokerage apps and related, the robo-advisors are using predictive data analytics, using artificial intelligence to steer folks to higher trading on the brokerage apps. They're generally steering them to the options market and earlier to the crypto market, where the fees are wider and higher for the platform. And there's inherent conflicts there. And even on the robo-advisors, steering sometimes people to the higher margin product for the platforms.
I want to move on and ask about a subject that's very near and dear to my heart. I'm sitting here on the floor of the New York Stock Exchange, where I've been for 25 years. And one of the things that I do almost on a daily basis is cover initial public offerings, or IPOs. It's one of my favorite parts of the job, or watching companies go public. You recently floated proposed rule changes on SPACs, special purpose acquisition companies. But I'm wondering, what, if anything, could be done to improve the IPO process? It's disconcerting to me, covering this for 25 years, that so many companies have elected to remain private for such a long period of time, so that when they go public here at the NYSE or at the NASDAQ, they're already middle-aged companies, essentially. So the investing public often fails to be able to participate in the companies when they're at their youngest stage of development. Can we do something to still protect investors, but facilitate the process of going public?
Bob, maybe it's because my dad had a small business. It never had more than 35 employees. They never made much money, but it did send us kids, 5 of us, to college and pay down the mortgage. I think part of the American success story is that we have vibrant public markets and private markets, and they do compete. And so in that realm, yes, it's helpful for the SEC to hear from the investing public, from the venture capitalists, from the issuing public, as to how to ensure our initial public offering market works smoothly, protects the public, but at a low cost. And so, yes, it's important. We did put out a proposal on special purpose acquisition companies, and these so-called SPACs were an alternative way to go public. And I think that kind should have like treatment. Like just back to crypto. Crypto's raising money from the public. It should have disclosure. Crypto is trading on exchanges. There should be investor protection. You shouldn't have manipulation or front running on those exchanges. Well, similarly, the SPACs had a lot of hype, a lot of hope for the investing public, but let's make sure the disclosure is proper around that, and also that the gatekeepers, the underwriters, are doing a job that's similar to what they do in the IPOs. But good ideas on the initial public offering market, let us know at the SEC.
What do you think happened with that? In fact, it's a bubble. It was a bubble. Let's call it that. It was rather remarkable to be down on the floor seeing that every single day. It seemed like some investors thought that SPACs were some shortcut to going public, that somehow they had more freedom to make comments on forward-looking statements than they would have on an IPO, and it seemed like some made rather outrageous comments about forward-looking statements. What happened there that people sort of got the impression it was an end run around the IPO process?
Well, Bob, maybe because that's what some gatekeepers, lawyers, and investment bankers were allowing and facilitating, and the promoters were getting and still get 20%. Now think about that, 20%, a blackjack company raises $1 billion. And if it does a deal, 20% of $1 billion is $200 million for the promoters that often aren't even going to be part of the ongoing company. And then some private company wants to go public and says, maybe I can go public through that blank check company. And the investors in the blank check company remarkably had a redemption right, still do, and they can redeem for the same $10 a share and yet vote for what might be a bad merger on some set of projections, a hockey stick set of projections. And there was outside bankers looking the other way and lawyers looking the other way, where there's still potentially underwriting responsibilities, the gatekeepers. Back to Chair Kennedy, they put in place in the 1930s the idea that there was a gatekeeper, somebody to look closely at the registration statement, look closely at the financials, and put their name on the document as well.
So what I find interesting is some of your proposals around human capital, for example, and diversity of board members. This, of course, is an issue for this organization that's sponsoring this today. Can you explain why that is important for investors? Some other people may say, well, is this really within the purview of the SEC, promoting fair and orderly markets, for example? This falls into the rubric of social justice that the organization that is sponsoring this event is very much interested in. Can you address why that is important for investors in corporate America?
So just broadening it out a little bit, the workforce is one of, and in many companies, the most important asset. And CEOs, boards of directors say this on a consistent basis. I know when I was at Goldman Sachs years ago in the merger and acquisition area, we would sell companies and we'd always have a good solid write-up about the employees, about the turnover, about their pay, about part-time versus full-time, about their benefits, and have a sort of a serious discussion because of how important the asset was, and frankly, how's it compared to competitors. And so over the years, the SEC has addressed it. My predecessor, Jay Clayton, put in place something on human capital disclosure. We looked at the first last year. We're looking at the what are companies doing this year right now in this year's filing season. And we're looking what improvements could be made on the human capital disclosures. And frankly, some companies are quite robust, and other companies, it's like 2 paragraphs and 1 number. And so we're trying to look at that. You asked about human capital with regard to diversity. Also, a number of companies, many companies are supplying information on diversity to the Department of Labor, and some are making that information public. And so we're taking a look at that as well, but we have not yet made any proposals.
And just going back to what's in the purview of the SEC, promoting fair and orderly markets, for example, make that case that it's important for
Oh, that's easy, Bob. Bob, it's easy because one, my predecessors already have voted on this and voted a thumbs up. Yeah. And so it's public already, human capital. We're really looking at the disclosures companies have been making 2021 and 2022 and saying, how can we help improve those disclosures and get them more consistent?
Yeah. So you've got a series of proposals out there already in the preliminary stage where there are proposed rules. There are more coming, more proposed rules coming. It looks like you're going to have a very busy end of the year. I've asked you this before, but I'm wondering if you can give us some clarity on what your priorities are at this point. There's going to be an awful lot of proposals that are going to need final votes somewhere down the road. The comment period's going to end. They're either the SEC staff is either going to extend the comment period or go to some kind of interim or final rulemaking stage. At some point, you're going to have to vote on an awful lot of proposals down the road. Can you give us a sense of what your priorities are with 50 proposals potentially? It seems like an awful lot of issues for you to deal with.
My North Star, as I'm a markets guy, is to ensure that these markets work best for the investors on the one side, and particularly regular folks, retail investors interacting with the big institutions, that we level the field better, and the companies on the other side. So much of what you'll see, whether it's in the stock market, whether it's in the treasury market, whether it's in the private fund space, and yes, even these climate and cyber and other disclosures, it's about the middle and about driving greater transparency and consistency, and yes, competition in the middle of the markets to make our capital markets even better than they are. We can't take anything for granted. There are always some challenges. We talked about crypto. We talked about SPACs. There's always some. We talked about payment for order flow. There's always some challenges in markets in rapidly changing technological times. So that's my North Star, and we'll propose that which we propose and adopt what we propose when they're ready. So I'm not going to get into the what month is this or that going to happen. But that's my North Star. I'm thinking about my dad throwing me those value line tear sheets when I was a kid and said, to us boys, what do you think? My sister was already off to college.
Value line is still there. We talked a little bit about your overall agenda. What about your personal agenda? What are your plans for the next several years? Are you planning to stay at the SEC? Do you have other ideas? Where do you want to be in the next couple of years?
This is unbelievable. The privilege of a lifetime to be at the SEC. I knew about it when I was a kid. I knew about it when I was at Goldman Sachs. Deep respect. I'm so honored to serve a third president, President Clinton, President Obama, President Biden, that they've each given me the chance, and the U.S. Senate's given me the chance and confirmed me a handful of times. So my term runs until June, I guess it's June 6th. It was the birthday of the SEC, but June 6th of 2026. That will be, to circle back around, that will be the 92nd birthday from when Chair Kennedy stepped into the role. So
that is quite an accomplishment. Gary, I've been covering the SEC for 25 years. I have to say, you have kept me and a very small group of reporters that cover financial issues in the SEC very busy in the last year. It's been very interesting covering you, and I look forward to continuing the conversation with you in the future. Thank you, Gary Gensler, Chairman of the SEC, and everyone, thank you for joining me in my conversation with Chair Gensler.
And thank you to the public. Thank you, Bob, for the interview. Thank you, Kerry, and everyone at the Robert F. Kennedy Center for Human Rights and Justice. I hope Kerry got the name right. I know you changed it a few years ago, but it's just terrific to be with you all.
Thank you, everyone.